Okay, grade 9s, let's look at our new chapter, module 4. It's on credit sales. I've got a special presentation here for you, breaking it all down. So let's take a look at what's going on. First of all, there's some theory that we need to cover. These transactions will be without cash. Like I've mentioned, we're no longer working with cash. We are actually going to go to credit. That's the opposite of cash. The customers will come to us and they will put it on an account. So we're first going to look at it from the customer's point of view. So in our store, you can either have a plastic card or we just write your name down on an account. You don't pay us straight away. And then they can come back normally we go for 30 to 60 days and we ask our debtors to either physically come back or EFT us by the end of the month, depending on what our agreement is with them. Okay, terminology, words. These customers we are now going to call debtors. We refer to them as debtors. It is confusing because they are buying on credit, but we call them debtors. Okay. Then secondly, is it a good thing if your brother or sister or your mom or dad owes you money? Yes, it's an asset. So there's people out there, debtors, who owe us money, and we see them as an asset. So when people come to us and they buy on credit, it's a good thing. Let's break down page 55, if you've got your textbook next to you, some more theory that they cover there. First of all, we're focusing on retail. We are selling and buying, not necessarily service businesses, and we're talking specifically about customers. Then they are buying on credit. That's another word that you need to get used to, and we have an agreement with them, and it varies from shop to shop. Then we will also speak about it that they're buying on account, same as on credit, and the only difference is there's no cash involved as previously. Then, like I've said, we call them debtors because they are customers and they owe us. And then on the right-hand side, what will follow in another chapter is creditors. And they're also a credit transaction, but this is when we are going to our suppliers and we are buying on credit. Press pause on that last one, that's coming soon. Then there's 3 ways that you can buy on credit. First of all, you can open an account with a store. You might get a plastic card or not, but your name comes on a list and they have the agreement with you. Other one is a credit card. A lot of your parents have got credit cards, and this is agreement they have with a bank, not with a store. So when they do swipe that card, your parents actually straight away pay the store. The store gets the money from the bank. But you have to go back to the bank, and normally it's every month, and pay them whatever you spend. And then lastly, if you want to go for a loan option, you go to the bank and agree with them to put money into an account, or it can be even cash, and they give that money to you as a loan. Sometimes you can have more than 6 months or a year to pay back this money. And this is probably for when you're buying a house or a car that you'll apply for a loan. Ways to buy on credit. These first 2 that you see here, Cotton On has got a gift card. That is not credit. Okay, that's a cash transaction. Typo, they've got a loyalty card. Again, it's not credit, even though it's a plastic card. These ones on the top left, they are credit cards. We are not going to work with them in this chapter necessarily, because at the end of the day, when somebody comes into our shop and gives us a credit card, it's cash, because we get that money straight away. That customer has to go back to the bank and sort it out with the bank. Here's one from Forever New. This is actually a store card. So you'll have 31 days or 60 days to pay back whatever you bought. There's also one from Zara Home. That's also a store card. And then they're referring here to a loan. So this one is cash that you are getting from the bank or money into your account. But there's obviously going to be agreement on this and months and possibly interest involved in this one, whereas store cards normally don't have interest. True as Man's another store card, no interest for the first 6 months, and then Woolworths, you can also have a store card. Note that this is not a Woolworths points card, it's a store card where I pay them later. Okay, what will your document look like? Now you might get a slip printed, or if it's more formal, they'll give you a proper invoice. Invoice will have your details, as in your address, your number, whatever. And then if you look at those 3 tables there, quantity, how many pairs of jeans did you buy, description, faded, high-waisted jeans, I don't know what you buy, how many, and then a subtotal of 2 or 3 jeans prices together. Note that that 14% VAT there is incorrect. It's outdated. Okay, and there's a list of everything that you will find on this invoice, noting that the date obviously will also show. Then you go to the next one, which is the journal. We're just looking at it. We're not going to start with it straight away, but it's such a simplified journal. There's very few columns in this one. On the left, you'll start with your invoice number. You'll have the date, then whatever the debtor or the customer's name is, and then they have a number in the folio. And then there's only 2 columns. Sales will have the selling price of the total for the items, and then cost of sales will have the cost price for the total price of those items that the person bought. And yeah, I had a famous grade 9 last year, only realizing 2 weeks into the chapter that DJ doesn't stand for a disc jockey. It stands for a debtor's journal, just so that you know. Okay, then we've got some more theory. It's about the National Credit Act. Guys, you do not want to get in trouble with this one. First of all, for consumers, it protects us. Whatever shop or wherever you're buying, they have to give you all the information up front. They have to tell you how much interest. They can't just charge fees. They have to inform you. Previously, they could do that, and now the rules are a lot stricter. And then something interesting. If you, the customer, they are doing a credit check on you, seeing if you've been paying other accounts. Everything's connected out there. It's like a big brother. They can check how you've been behaving on credit. Then they used to just increase our limits and say, oh, now all of a sudden you can go back to Trueb's and buy for 7,000 Rand. Crazy. Well, I don't have that money. But now they have to first ask you, can we increase your credit? And then there's the famous credit bureau. You'll have a question on them, but this is where everything comes together. And if you contact the credit bureau, you can find out if somebody's been blacklisted. If you don't know what blacklist means, ask your parents. It's a very interesting conversation. And then lastly, on the theory side, Consumer Protection Act. What is this? There's a lot of points on them, but for now, we're just going to look at 2. First of all, your customers can return their stock. If they don't like it and they're not happy, they can give it back. And it actually says if they do it within the first 6 months, and obviously it didn't meet the standards, so they can prove that it isn't what you said it would be, then they can do that. Otherwise, there's 10 days if they haven't viewed it. So that's from the internet. If you're buying from the internet, go read through that. Another thing that you have to know is if your stock is not delivered on time, or the date is wrong, or the place, then the customer can cancel the transaction and say, you know what, I'm just cancelling. They're allowed to. Do note that there's 5 rights, or major ones. There's lots, but we're not going to look at them in detail, but it's about safety, choice, voice, and redress. Now we're getting to the section that's actually for your AOL, which you need to look for your homework. First of all, I'm showing a familiar transaction. You bought your goods with a check. So this means you paid for it cash. So first of all, your trading stock will go up because you're buying goods. And then secondly, your bank will go down. This one you're familiar with, okay? Now, the next one is also one you're familiar with. You're selling the goods, those goods that you bought, for cash, some of it to the customer, not all of it. And what happens here is your trading stock, your bank is going to go up with the selling price. So let's say you sold it for 2,000 Rand and your selling price is going up with 2,000. But this says only part 1. Remember, I've now taught you there's this transaction that has got 4 accounts because the selling price has got a debit and a credit, and the cost price has got a debit and a credit. So do note for the cost price, you'll have to work out the cost price. It's 1,200. There's a mistake on the right hand side. This should be 1,200. Note. Cost of sales is the expense, debit, and your trading stock is going down by 1,200, not 2,000. So what happens now if you are selling those goods to a customer on credit? Guess what? Bank is going to disappear. And in the place of bank is a new account, and it's debtors control. Good news, it's also an asset, and it's also going up, same as bank. It's just got a new name. For the cost price, also good news. Nothing actually changes here. It stays exactly the same. Cost of sales is recorded, trading stocks going down. So the only difference will be for the first part of the transaction. Finally, my customer is coming back to me, and he now wants to pay me that 2,000 Rand that he bought for. Bank's going to go up, I'm smiling, and then my debtors control, the asset, is actually decreasing because now that person don't owe me that money anymore. And that's it, guys. I hope it makes sense. If you've got any questions, please post.